Hi, everyone. My name is Anae Agostini. I'm CEO of CID Insurance Programs, and I'm going to be your speaker today, along with Mackenzie O'Neill, our no payroll work comp and fidelity underwriter, Lexi Johnson, our professional liability underwriter, and Michelle Belden, our nonprofit and habitational underwriter. Of course, we have Jacob Cole, who's our marketing coordinator, who makes everything run smoothly. So, welcome to our HOA insurance strategies in a hard market. We had a lot of response to this, a big group of people interested in trying to better understand what's going on with this industry. So let's dig in and talk about it. I'll give you everything that I know, and I've got our underwriters on with us as well, so they will be available to get very specific about questions that you may have. So, logistics first. All participants, you're going to be muted, but questions can be posed in the chat room because your voice is important to us. We want you to ask questions. A short survey will pop up after the webinar, and we'd really appreciate your feedback as well. Okay, so what are we going to be talking about today? Obviously, let's gain some insight into the turmoil surrounding the HOA's industry's hard insurance market. We're going to discover some of the critical role of smaller HOA insurance coverages that get overlooked at times. Better understand the HOA no payroll work comp and fidelity coverages and exposures. And then let's gain some knowledge of how fidelity claims trigger coverage on both the HOA and the Management Company Fidelity Insurance. And then last, let's talk about the coverage gaps and overlaps with fidelity and cyber liability and fidelity insurance. And included in that is we're going to talk about cyber liability towards the end of the webinar. So let's get started. First, let's start at the beginning here. And this is where everyone's feeling the pain. And that is we've been experiencing the commercial insurance in general, but specifically in the HOA industry, we're going to talk about today. We've been in a hard market cycle actually since 2019. It started then, but it crept up slowly, and then basically, really started to go hard in 2022 to all of 2023, and so we're really in the painful part of the hard market. So hard market versus a soft market, that hard markets, it's usually cyclical, and it used to be about every 7 years into many different factors, which I'll talk about, will push us into a hard market. But really, a hard versus soft market, the hard market is really a seller's market. When we move into a soft market where everybody has, the premiums are very competitive, everyone's falling over each other trying to beat out the other person with lower prices to get the business, that is a buyer's market, obviously. So just a little understanding, and we were in a soft market for an exceptionally long time, and then many economic factors caused us to move into this hard market in 2019. What are those factors? They range from COVID, of course, because it was really late 2019. I think that the real effects started with COVID. Catastrophic losses, right? Fires, and especially on the West Coast, fires and hurricanes and tornadoes and all of that. Economic inflation, obviously that's having a huge impact on all businesses. And then social inflation, which that is sometimes people don't understand. This is directly related to insurance. And it's a term that describes how insurers' claim costs are increasing above general economic inflation. So it's generally thought to be due to a trend in increasing litigation costs brought by plaintiffs seeking large monetary relief for their injuries. And believe it or not, courts and juries are actually favoring, these potentially injured parties or allegedly injured parties, and the payouts have been just extremely large, which is really, really causing havoc, and that is causing premiums have contributed greatly to liability type claims for businesses and for the insurance companies. So, and for you as brokers, the hardening insurance market is really creating a labor-intense process for your business, because you're having to manage the risk placement and obtain new quotes for each renewal, and that's labor intense. And so that's something that I'm hoping that you can take a better look at who you're doing business with and make sure that you're working with someone who can help you reduce that labor. Okay, so the coverage issues facing HOAs today. We're in the hard market. It's for the West Coast. It's mainly due to the wildfire risk, and more states. California started it. More states are being affected as more areas burn. Property insurance is being non-renewed as carriers have reevaluated and expanded their high-risk fire zone models. So that's where a lot of you are feeling the pain and having all those policies non-renewed that were in standard markets and now are going to be in E&S or excess and surplus markets, which is going to increase that premium. The social inflation I just talked about, that has impacted D&O and general liability, and it's really because they're paying out so much in claims, they're having to change their underwriting guidelines, and they're pushing those premiums higher. And some carriers are pulling out. Umbrella and excess liability is the same issue, because now you're getting into those the higher excess umbrella limits. It's because those claims are so large that they push into the excess policy, and that many carriers are just not writing this coverage at this time. Generally speaking, once this blows over, and we move back into a soft market, you'll see more opportunity. I wanted to take a moment at this time in the webinar to ask Michelle Belden. She is our habitational underwriter, and if she could speak to a little bit about the markets that we have available and underwriting guidelines that she's seeing, that so that you can be educated a little bit better about that. Take it away, Michelle.
Thanks, Anae. Hi, everyone. Thank you for joining us. So I just want to go over some, underwriting criteria. A lot of questions that I get from a lot of our agents, like what can we help them with these days? Because like Anae said, we are in a very hard market right now. So, placing coverage for your insureds has been a difficult challenge for everybody. Some people are only able to help them with a GL, while another carrier is helping them with a property. So sometimes, you're having to split coverages now, and it's not as nice and neat as it used to be, where you were getting a bought policy from our preferred markets. So given the state of the market and what options we have available, things to be taking into consideration when having to remarket these risks, because every carrier varies, because each carrier has made their own changes to their guidelines. Some have exited the market altogether, as you're seeing, because you're getting the non-renewals on a regular basis. Others are saying, okay, we're still going to write this class, but we're going to scale back on what we consider. So for us, it depends on the risk. That's what I literally lead with everybody these days. It really depends on the risk and if we will have a market for it. It's really hard to generalize saying, oh yeah, we have a market. I always say it's something we can look at. It doesn't necessarily mean that we'll have a market just because of the state of things. So things that I'm looking at determine market availability would be number of units. Some carriers have a unit cap. Number of stories. Some carriers have a story cap. TIV caps. Age restrictions. Some of our markets don't have an age restriction, but they would be looking for updates to the wiring, plumbing, heating, and roof within the past 25 to 30 years. Sometimes that update year range, maybe a little lower, maybe a little higher, but I would say about 25 years is probably the sweet spot. That too is for them to be able to qualify for special form replacement costs. So if they don't have those updates, we could still look at considering the risk. It would just potentially be on a basic ACV basis, which obviously most condos aren't really looking for a basic ACV policy, but sometimes, especially given the current market, we have to take what we can get so they at least have some coverage. And as I said too, if for some reason we couldn't help you with the property because for X, Y, or Z it doesn't qualify with our markets, we could look at writing monoline GL for the account. We can also look at writing monoline DNO, and then yes, my other coworkers who can help with the no payroll work comp, the fidelity, and the cyber are additional coverages that we can look at. As far as it comes from a wildfire or brush perspective, as Anaya mentioned, yes, it started in California. It's definitely expanded outside of California. A lot more of our carriers require us to run a risk meter in states outside of California. I would say we are not a market for anything that's in a high or very high wildfire area. So we're looking at not only the score ran by risk meter, but also the distance to high brush and very high brush. So if something, say is a score of a 35, but their distance to high brush is 1,800 square feet, and their distance to very high is 2,000 square feet, 2,000 feet, then it's not something we would have a property market for. And the score might be on the lower side of things, but we also have to take into consideration that distance as well. A lot of carriers have tightened their appetite on that specifically because of the losses they have seen and the payouts that there have been. So, they'd rather be more conservative at this point in those areas. A lot of people are having to take this business as in the very high wildfire areas, especially in California. They're going to the California Fair Plan, or they're going to, E&S markets who have to offer them excess property limits where you're paying upwards of $500,000 plus if it's a really large association. So, associations didn't have the budget for these things when all these changes started to happen in the industry. So associations themselves are having to make changes. Some, condo associations that have the ability in their CCNRs to convert their association from a condo association to basically like a single family home type association, to put the insurance back on the individual unit owners instead of the condominium purchasing the insurance for the buildings because of the cost, and they don't have it. Not every association has the ability to do that, but that is something that I have heard my agents tell me that some of the associations are having to do in order to be able to maintain coverage. Not having coverage is an issue, and then not maintaining an appropriate coverage is also an issue. Other things that I get a lot of questions on are loss history. Loss history is really tough right now. We are looking for, everybody's looking for a pretty clean risk, which is kind of hard these days. There have been a lot of claims in the recent years. So if somebody has a lot of frequent, let's just say water type damage claims, maybe they've had 7 in the last 5 years. I would tell you, even if it was a smaller payout, it likely wouldn't be a favorable risk with our markets because they've had 7 similar type claims. So when it comes to loss history, some of our markets are a hard no. If there have been losses, they're automatically out. Some will consider some loss history. And then, sometimes we have those markets who can consider, pretty horrendous loss history, but you're going to get a pretty stripped down policy. But, again, still providing coverage because they do need the coverage. When it comes to loss history, we are looking for loss details. So what happened, confirming damages have been done. If they could take actions to try to prevent them from occurring again. It's really important things. The more information you can provide, the better story we can provide to the carrier to try and sell the risk to them in order for them to offer us coverage. So the more information, the better that we can get.
So there's a couple questions, Michelle. Do you offer wraps around the California Fair Plan property coverage?
No, unfortunately, we don't have any DIC or wrap type markets available, so it's not something we would be an option for from a property perspective. But we could look at that monoline GL and any other coverages for them, just nothing on the property side of things if it's something that's with the Fair Plan because it's, claims written or.
second question is properties over 30 years old seem to be a problem. Carriers want updates. Which carriers are open to buildings over 30 years?
So like I said, we do have markets that don't have an age restriction. However, to qualify for that special form replacement cost, they would be looking for the updates within the past about 25 years. I would say is the average of our markets. And if they didn't have those updates, like I said, if that carrier doesn't have a specific age restriction and they don't have um, the updates, then we can still look at the risk. It would just be on basic ACV form.
Okay. Thank you so much, Michelle. That was really valuable information. I hope it helped everyone answer the questions in their own mind. So I'm going to continue on now, and we're going to talk about small coverages for HOAs and the fact that they're a lot of times overlooked and can be very important. So standalone policies outside the package policy, or in these days, it's probably individual policies that you can't even get a package in with some of the complexes that you're trying to insure. Standalone policies can provide broader coverage on your fidelity, your umbrella, your no payroll work comp, and your D&O. It's really important to educate your boards about these broader coverages because there are potential coverage claim gaps that really need to be addressed with your boards. Sometimes you can get a package well, if you could get a package policy, sometimes there are some carriers that might offer fairly broad fidelity coverage, but as a rule, they typically don't, and so you are missing some coverage claim gaps, and I will talk a little bit about those coverages. Also, broader coverage is going to probably vary the cost a little bit, and so that's why you really need to educate your boards on as to not missing that coverage that they potentially could cause them a claim or uninsured claim later. And then for you as brokers, just remember you need to propose all the coverage for the HOA potentially needs in order to protect your own agency E&O exposure. Because if it can happen, it's always going to be when you haven't offered the insurance or to the insured, and they have a loss related to the coverage you didn't offer. That's going to be on your E&O exposure. Okay, so let's talk about some of these small coverages. HOA no payroll, work comp. Why does an association need to have this coverage? Well, HOAs have an inherent exposure of a premise worker injury, where at the time of the injury, there is no insurance to cover the loss. And if a worker is injured, who is going to pay for the medical bills if there is no insurance in place? This type of exposure is not covered on other association liability policies, so can become an out-of-pocket expense. So this policy, so what does the HOA work comp policy cover? Well, those are probably two closely related questions, but the policy is designed to cover the what-if scenario. So a worker is injured, and there's many different ways that they can become basically the employer or responsible for that particular injury when it happens on the premise of the association. It's a low-cost, a very excellent low-cost risk management tool for HOAs. So who should be covered on the HOA policy? Well, workers working at the HOA premise where at the time of an injury there is no work policy, there you want to make sure that the board of directors, committee members are covered on this policy because those are, I'm going to talk a little bit about the things that can happen and why they should be covered. How's the premium established and is it audited? Well, the premium, we've had a program for I want to say 30, 35 years maybe. That we were actually created the first program in the HOA industry for no payroll work comp because associations were incurring all kinds of out-of-pocket expenses related to a worker injury. And our minimum premium is just a flat minimum of $350 plus, the taxes and fees. And our policy is not audited but some of them are in the industry. And the great thing is since there's no payroll, it's a minimum premium. There is really not a great need to audit the policy. So that makes it so much easier with you have a non-audited policy. So how do you determine who's considered an employee versus an independent contractor when hiring a person to work for the association premise? Well, and I want to say that most of the big vendors, they're that's not who we're talking about. We're talking about the small people where there could be a question as to whether they're an employee or an independent contractor. And most state law presumption is that hiring an independent contractor who is unlicensed for work that would otherwise qualify him for a license will be considered an employee of the association at the time of an injury. Just deeming someone to be an independent contractor is not enough. They need to be licensed, insured, provide their own equipment, and make their own schedule. Otherwise, they become an employee, and the association would be financially responsible for a worker injury. The no payroll work comp policy is not a solution for that scenario. So that sort of answers that question, how to define employee versus independent contractor. Employee is someone who's directed by, told what to do, given the equipment. The schedule is set by a so-called employer, and then independent contractor, someone who's licensed, has their own insurance, workers' comp. They are a functioning business that can show that they're completely independent. They make their own hours. They bring their own equipment, and that's the difference that you will see in that. And that sort of covers number two. But how can an HOA become the employer of an vendor's worker? So that answers that question. They become by hiring someone who's unlicensed, does not bring their own equipment. The HOA provides it. They basically set their schedule, their hours, and then they become an employee if they can't meet that list, the independent contractor litmus test. How can an HOA management company become potentially liable for a worker injury at the HOA premise? Well, I'm going to talk about a claim scenario related to that on the next slide, but they can become liable and get pulled into one of these worker injuries at the premise. And I think my next slide will cover it because I've got some claim examples. The HOA board of directors injuries are the most common claims. It's just inherent that they're out on the property doing something. They are doing a walkthrough with the management company. They twist their ankle or maybe trip on something and fall over and hurt themselves. So that's over the years. That's where I've seen, and there's those are the claims that I've seen the most. Next, I think you would fall into the HOA committees appointed by the association, the board of directors. They need to be appointed to be covered, and often they to attempt to save money by doing work themselves on the premise rather than hiring a licensed contractor. So I've seen everything from chainsaws, cutting down trees, the committee in rural areas where they take on these jobs, and and you panic and you get nervous and recommend that they not do that if you're going to write a no payroll work comp for them policy. But that scenario, that's where I see other claims related to HOA committees doing their own work on the premise. HOA board members or an HOA manager often direct a vendor's worker to do specific work, and in the scope of that, or in the process of doing that work, the worker is injured as a result. Well, both the association and the HOA manager can end up being responsible for that, even if you're working with a good um, established independent contractor. I've seen it happen, and it was a big claim. The HOA management company was held liable for hiring an unlicensed contractor, even though the board they had brought forward. The management company brought forward 3 bids, and they picked the lowest one, and it turned out they were unlicensed, and the management company had not checked. And so the day work and this vendor hired a day worker, and they were seriously injured while working at the premise. So that's another example of how you can become responsible for a no payroll work comp claim. Okay, let's talk about Fidelity. I think it is one of the most overlooked and typically underinsured coverage when compared to the financial exposure of the HOA. So it's really important to have broad coverage in this area. So how do you determine the limit of coverage that's needed for an association? Well, it's an equation. 3 times monthly assessments plus, I say, all the cash in the bank. That's the total limit, and it needs to be reviewed every year. Because the funds change, you add money into your reserves, you may get a settlement sum of something, maybe construction defect. You need to increase your limits, but it needs to be at least reviewed once a year. And so it's important that you do that. The HOA board of directors have a fiduciary duty to protect the association funds. So they can't pass that on to the management company. They have their own fiduciary duty to protect those funds. Who should be insured on the HOA policy? Well, you definitely want the board of directors insured. You would want committee members insured. And I think I'm going to talk about it a little bit more later, but of course the management company should be insured. So Fidelity coverage, it can vary substantially. A lot of times it's packaged versus a standalone policy. And then discovery form versus loss sustained form. You want discovery form because it uses today's limits and deductibles for prior losses and prior acts. So if you've increased your limits, you're not having to go back. Loss sustained, you have to go back to the policy that the loss occurred on and the first date of knowledge, the loss, and then you would have to use those limits. So it's better to have discovery form. So what are these coverages that we really want to have? Well, most policies will have some form of employee theft coverage, and it's covering your money, securities, and I've seen some property losses. Very expensive rugs and high-rise condo association that were stolen. So, but it's against losses, through the dishonest acts of any of your employees, community managers, and principals. That's an important coverage. That's the main coverage. And then you want to make sure this is a coverage that sometimes is not on a package policy. That's computer fraud coverage, and it covers the loss of your money and securities and property. But this is basically a third party. It's computer fraud by a third party that's basically breaking into, they're phishing their way into your computer or network, and they're able to get the biggest exposure is being able to get banking sign-on information, and then being able to go in and basically steal the money from the bank accounts. Forgery and alteration coverage. It's not a big coverage that I see, but I just wanted to mention because I've seen over the years a few, and it's really the alteration or forgery of checks, and that is occurring far less because so much of this is going ACH, and there's not as many checks involved. But paying vendors, that a lot of management companies are still paying vendors, and so that's a coverage that probably the HOA should have in case it happens on the management company's watch, and they don't have that coverage. Deception fraud is an important one that is missing typically on a package policy, and that covers the loss of intentional misleading of a person to get them to part with money or securities, and that's by pretending that they're an employee, an owner of the insured, vendor, customer. They're an imposter, and then they just divert the this is a money and security. I mean, this is a wire transfer type loss that happens quite often at management company level. Okay, so management company versus HOA with Fidelity Insurance. HOAs should add, as I mentioned earlier, their management companies to their Fidelity policies as additional insured. And this is a mandatory requirement in California. I'm not sure about other states, but it's a really an important practice, because who has the care, custody, and control of the funds? It is, generally speaking, the management company. And so the association really wants to make sure they have that fiduciary duty to make sure that they are insuring the full exposure, just in case. So, and that covers the management company must provide their own Fidelity insurance that will provide coverage for their managed association. Sometimes I see them wanting to just have the management company. They both need to carry the coverage, and the association should include the management company as additional insured. The association management company should just have a coverage, Fidelity coverage, that covers all the funds that they have under their management. And again, I want to mention that the HOA management companies will never be able to insure 100% of the association funds they manage. That's difficult. That's why the HOA should always have a Fidelity policy that covers the management company. Okay, some Fidelity claims. Largest ones have involved the management company, believe it or not, officers and owners that steal the association funds under their care, and that's their policy, the management company's policy. But again, if they didn't have enough coverage, that the association's policy could kick in, because you've named that a management company as additional insured. But it's a shame. I have seen it, the largest claims happening caused by company officers and owners at the management company level. Deception fraud claims at the management company level, like the fraudulent wire transfers. That's, again, where the interception by hackers that ultimately transfer the funds to themselves. And then computer fraud and funds transfer claims happen to the at the management company level, where hackers break into the computer system, and then they steal the banking credentials and then steal the funds in the account. Okay, so now we're going to move into the differences between cyber liability versus, Fidelity Insurance. Fidelity Insurance is really focused on the employee theft of HOA funds, but does offer coverages such as computer fraud and funds transfer and deception fraud coverage. Those coverages can potentially be also covered on a cyber liability policy. So cyber liability is focused on covering electronic theft of private information and covering ransomware attacks and but other coverages such as cyber theft coverage can potentially overlap with the Fidelity policy forms. So you could have both coverages on both policies, and you have to be careful because there are other insurance exclusions that basically say, hey, we're excess if you have another policy. So, and if they both say that, you've got a problem. So potential coverage gaps can exist as well, and the cyber liabilities as some do not offer cyber theft coverage. So it's important to not overlap coverage or have a coverage gap. And McKinsey is our underwriter for no payroll, work comp, and Fidelity Insurance. And so you can reach out to her with any questions that you may have if you would like to learn more about this. So understanding HOA cyber liability, cyber insurance, it's protecting businesses from various and evolving risks related to security and privacy. And these risk exposures continue to grow as digitization accelerates, right? And that's on high speed right now. HOAs, they contract with the management company, and the management company has the care, custody, control of the association's funds. So it's important to consider who needs coverage and who's covered on the cyber policy. So it's important to consider who's an insured as well when you're looking at a cyber liability policy. So if the association, ideally, a management company should have cyber insurance, and it will cover all the funds that are in all the information they're storing for the association and all the funds that they're managing for the association on their policies that are under their care, custody, and control. But so they really don't need to add anybody onto their policy, but it's important to consider who's an insured. So for an association, and you want to make sure that you have automatic additional insured coverage should the management company should include the management company when cyber liability is written for the HOA. So I hope that made sense. I think it would be between McKinsey and Lexi, I think that you'll be able to get more information if you'd like to understand this better. So I have a question. Do you have cyber markets available, and can you speak on the bill passed in Nevada requiring HOAs to have cyber? And Lexi, I'd like to invite you to answer this question if you would, please.
Yeah, thank you, Anne. So some of you may know Nevada, they posted in March of 2023 a Senate bill, it's Senate Bill 378, where they passed HOAs are required to carry cyber liability insurance, and the limit requirement is actually based on the unit count of the HOA. So I think it's important to note, businesses of all sizes are vulnerable to cyber attacks. Some HOAs, they utilize email, they have connected devices such as Wi-Fi routers, IoT thermostats, and if they have these, then they're exposed to hackers. Hackers can strike at any time. So since this bill has passed, we have received multiple submissions for HOAs, not only in Nevada, but actually, in many states. And we do have cyber markets for HOAs. Actually, we recently launched a cyber platform where it takes only 3 to 5 minutes at most, and you, the retail agent, can actually quote these yourself on this platform. This platform can actually provide up to 9 standalone cyber quotes from leading cyber carriers, and I have seen policies as low as $200 for an HOA. So they're very affordable. Jacob will actually be sending this link over to you after the webinar, so you can start quoting, or you can even access the link on our website, which is CIDinsurance.com.
Thank you, Lexi. That's good information. So this is our closing slide. It's our hard market closing thoughts. If your HOA is being non-renewed, please allow enough time to explore other carrier options. The carriers are moving like molasses with quoting because it's just so much going on in the E&S marketplace. And so please allow enough time. Michelle will thank you. Everyone will thank you. Educate the board about the condition of the marketplace, and that as a result, the premium costs will most likely be higher if they're being non-renewed. So it's really, you've got to have your board on board with understanding. You don't want to make it a surprise. And then take inventory of your carrier, MGA, wholesaler relationships to make sure you're working with an industry, HOA industry expert that can deliver what you need. And then build your success, understanding that the hard market will continue through 2024 and then potentially begin to show signs of softening in 2025. So I want to thank you for joining us. If you have any other questions, please chat them into the chat room. And make sure you visit our website, CID.com. And we've got lots of tools. We have recorded webinars that you can watch. And then submit your applications today at submissions@cidinsurance.com. Thanks for joining us.